Welcome to our educational journey into the fixed exchange rate system, fundamental concept in international finance and trade. In a fixed exchange rate system, a country's currency value is set at a fixed rate against another major currency, or a basket of currencies. This means that the value of the currency is kept stable relative to the chosen reference currency, providing predictability in international transactions. For example, imagine a country decides to peg its currency to the US dollar. If the fixed rate is set at 1 unit of their currency equals $1, this rate remains constant. In this system, the exchange rate between the pegged currency and the US dollar doesn't fluctuate, providing stability. To maintain this fixed rate, the country's central bank is actively involved. It manages the exchange rate by buying or selling its own currency in the foreign exchange market. If the currency's value starts to fall below the fixed rate, the central bank buys its own currency to increase its value. Conversely, if the currency's value is too high, the bank sells its currency to lower it. For instance, if the market pressure causes the currency to depreciate, the central bank might use its reserves of foreign currency to buy its own currency. This helps prop up the currency's value. On the flip side, if the currency appreciates too much, the bank might sell its own currency to prevent it from becoming too expensive for trade partners. A fixed exchange rate system can offer stability in international trade and investment. Businesses and investors prefer this stability as it reduces uncertainty in exchange rates. With a fixed rate, companies can plan their finances with greater certainty, knowing that the costs of importing and exporting won't vary wildly. However, maintaining a fixed exchange rate isn't always easy. If a country experiences economic problems, such as high inflation or a trade deficit, maintaining the peg can be challenging. For example, if inflation rises, the country's currency might become overvalued compared to its trading partners. This could hurt exports and lead to economic difficulties. Because of these challenges, many countries have shifted to a floating exchange rate system, where currency values fluctuate based on market forces rather than being fixed. In a floating system, exchange rates adjust automatically to reflect economic conditions, providing more flexibility for responding to economic changes. Today, many countries use a mix of exchange rate systems. Some maintain fixed rates, others use floating rates, and some adopt a managed float, where rates are allowed to fluctuate within a controlled range. A managed float combines elements of both fixed and floating systems, giving countries the ability to stabilize their currency, while still allowing for some market fluctuations. Understanding the fixed exchange rate system helps us see how different countries manage their currencies and how these systems impact global trade and finance. Thank you for joining us on this exploration of the fixed exchange rate system. Stay tuned for more insights into the fascinating world of economics. If you found this explanation helpful, don't forget to like, share, and subscribe for more quick concepts on finance and economics. See you in the next video.